Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. We'll dive right in, take a look, and see what people are sharing. If you want to follow me, it's @Finance. And if you want to join our community, we've got a nice little community. We've got a Discord channel. You can communicate with each other. We talk about stocks. If you like stocks, if you like the markets, if you like talking macro, so do we. So does everyone in the community. So you could probably find a pretty nice conversation on there. We talk a lot about individual companies and sectors and stocks, and a lot of people in the community are have learned quite a bit, including myself. I've learned quite a bit from everyone. We have a May Day coupon code, which is still active, 50% off the first month, or you can join a monthly membership. Anyone can. Even if you're an existing monthly member, you can always join the yearly and get that discount with that May Day coupon code. So we've got true market leader, first stage base, ideal buy for investors. So this is stage analysis. You get a downtrend, stage 4, stage 1 base, and then you get stage 2 upward moves. Notice the zigzags. We've got zigzags that come in. You generally get a double bottom in stage 1 is what he's showing here. And then you start to get up above that double bottom on the right-hand side. What's important about this is it's a description of the psychology of how humans interact with each other. That's what we're looking at. Right now in commodities, we are at the stage potentially of stage 1 in some sectors. There are a lot of sectors that are in stage 2 that have broken out of their base and are starting to work their way on up. Some people may not feel like that's the case, but it is the case. And these patterns take a long time to basically move. So we're early in this move. We're coming out of stage 1 and a lot of them into stage 2. We have some of them have already broken out, pulled back, and come up, and we're doing another pullback. Areas like uranium are doing that. Areas like dry bulk shipping. And then there are other areas that are just breaking out of this stage 1 base. A lot of companies in gold and silver mining are in the breakout stage of stage 1 into stage 2, depending on the companies that you're looking at. One thing that you can do is you've got leaders, and leaders generally break first. And you can buy laggards that are down here in stage 1. Some of the companies that are explorers can be in stage 1, while the developers are breaking out along with some of the producers into stage 2. You can take advantage of that if you are patient and you can withstand good, large volatility. And I think people lose focus on where we are located in this type of pattern here. Everyone wants the money to go, they want everything to just move. Just not how it doesn't work that way. It goes up, we get pullbacks, you buy the dips in a bull market, and then you hold on to the rips until you can size up that big move. And stage 2 is what we're sizing to go all the way up into eventually a stage 3 top. And that might take a long time, 5 to 10 years. And I don't know if people are willing to hold that long. And a lot of people aren't. And those people don't get the big returns. You have to do and be willing to do stuff that other people are not willing to do. And patience is one of those things. OPEC cuts global oil demand forecast for 24 and 25 again. Demand data from China, India, and Africa have all come in below estimates. China's growth story is weighing on this the most. The production cuts will be revisited during the next meeting on December 1st, 2024. Cartel cuts demand forecast for the fourth time. So we've got growth estimates from here for 11/1/2024 for 2025 of 1.5 million barrels for 2025. 1.8 million barrels year over year for 11/1/2024. Scottie Pippen, what the heck? I thought he was a heck of a player back in the day. Um, he's got some championship rings. Bitcoin in 2024 is giving me flashbacks to the Bulls in 91, a dynasty just starting. Get ready for what's next. Really? Bitcoin statement from Scottie Pippen? Now, here's my question. If Scottie Pippen is making tweets about Bitcoin, where do you think that puts us in terms of where that stage is? We are probably going into a blow off top if Scottie Pippen is talking about Bitcoin. Lance Roberts says Goldman Sachs forecasts the 10-year US Treasury yield to hit 3.85% by end of 2024, diverging from current futures market expectations. So they're actually expecting rates to drop down to 3.85%. Now, if we get that, if we get a 3.85 and yields drop, gold and silver are going higher. And we're probably going to see a weaker currency. The dollar will drop if that occurs. Now, right now, when I look at the markets, the momentum's to the upside still. It hasn't turned yet. So they're expecting a pretty big pullback in yields by end of year. So this is from Warren Buffett. Charlie and I decided long ago that in investment lifetime, it's just too hard to make hundreds of smart decisions. Therefore, we adopted a strategy that required our being smart and not too smart at that only a few times. So he tries to make less decisions. He tries to make better decisions in terms of his investments. And then he goes out and holds those investments for a very long time. He made a lot of money on See's Candy. He made a lot of money on Coca-Cola. Made a lot of money on a few investments. He's made a lot of investments, and a lot of investments have turned out poorly for him. But what he's done right is he's been ultra patient. He's put a good chunk of money in really good companies, and then he's held those companies for very long times. Coca-Cola and See's Candy and some of these other ones that he's held on for many, many years. Greg O'Donnell says Exxon CEO says USA cannot increase supply as they are already at the top end of production. That's kind of why I'm investing in oil. I mean, good thing. I mean, he spelled Exxon wrong, but whatever. But is that the case? Are we at the top end of production in the United States? Is shale plateauing? Is shale oil plateauing? I kind of think so. And I'm in oil for the fact that I think shale is plateauing. Like that is the thesis, one of the theses. And I think that the United States cannot stop credit creation. I think they're going to create money. I think that their debt is too high and that the divergence between credit creation and the supply plateauing in the United States is going to be a problem. Inflation problem, put it that way. Reads with Robbie says, you must develop the ability to be disliked in order to free yourself from the prison of other people's opinions, says Mark Manson. And that's where you want to be. You want to be a contrarian to some degree. Not in everything, but you want to be a correct contrarian. Oil price. IEA and Bloomberg foresee fossil fuel demand peaking this decade, with oil demand dropping from 103 million to 85 million barrels per day by 2030. But analyst Al Salazar warns these projections may be too bearish as electric vehicles market faces tariff challenges. That is what you're betting against. What I am betting against, if I were to do this, I think the general population or the general consensus viewpoint in the future is that we are going to use less oil and demand will be the driver. It's going to pay absolutely huge amounts of money if, it's a big if, demand doesn't fall and the driver of oil supply dropping is the driver of it. Now, in history, when you look backwards, energy has never really gone down in terms of production of energy. We use more wood today and we burn more wood than what we did a long time ago. We burn more everything. We burn more fossil fuels in terms of oil, natural gas, coal, everything. We've added a whole bunch of wind, solar, we've added nuclear, but guess what? We continue to burn more and more fossil fuels as time goes on. I don't think that that will ever reverse. So these guys that say that demand will drop, I just don't believe it. And I think if you make a bet and you're right, and you can make a bet with how cheap oil is in relationship to gold, it's at like 38 to 1, so 38 barrels to 1 ounce of gold. Historically, that's the second cheapest uh, price against gold for oil historically ever. So if the demand scenario that everybody thinks is coming and it doesn't come the way that they think it's going to come, and I can buy the opposite viewpoint at a price that is incredibly cheap, I'll take that bet. I'll take that bet and I'm willing to sit in it for 5 or 10 years and watch and see what shale oil does and what Saudi Arabia oil production does and see if these things plateau and start to head lower on any of them. If it heads lower, I just absolutely made, 5, 6, 7, 10 times my money. If I'm wrong and oil price stays low, then the downside is what, 30% or something like that? 30, 40, 50% if it doesn't really go much of anywhere. A lost opportunity. And I don't have to put everything in it. I can just use this as one of my ideas of maybe 7 or 8 that I have. Eric Niddle says there is no energy independence without Canada. With longer and stronger than consensus demand, a likely U.S. shale peak under the next Trump presidency. I want to read that again because everybody thinks Trump's going to drill, baby, drill and increase supply. He says a likely U.S. shale peak under the next Trump presidency, which means the next 4 years, we're probably going to peak. The strategic value of long dated, high quality inventory in a safe jurisdiction with strong environmental protection is Canada, 60%. Canada is the spot to be. It says the top 5 sources of U.S. crude oil imports by percentage share of U.S. total crude oil imports in 2022, where Canada was 60% of oil imports. And I think it's going to go up. And I'm glad that we are located right next to Canada because they're going to be one of the last exporters or the ability for them to export versus a lot of other countries. Jesse says, on price to sales basis, the stock market is very close to the record set in the post-COVID boom in 2021. On a price to book value basis, it's almost taken out the all-time high from the dot-com bubble in 2000. So this is the adjusted price to sales ratio. We're up very close to the peak of the post-COVID boom. You can see 99 2000 is a lot lower. And then price to book ratio, we are very close to all-time highs of the dot-com bubble. So what I try to do is I try to avoid where things are expensive and people are at, and I buy sectors and companies that are unloved in areas that are cheap. That's your contrarian play. That's your Howard Marks, your Warren Buffetts, your Charlie Mungers, all the guys of the value guys are buying stuff when people aren't looking. They're ninja buying. And then the people who are chasing into Bitcoin and crypto, good luck. Like that's where everyone's at. And if retail is there, all I'm going to say is good luck. Because that's where it's going to potentially and eventually bust. Now, does that mean that it will bust immediately? No, it doesn't. It can go up further and it can go up longer. That's where the markets can stay irrational longer than you can stay solvent if you try to bet on overvaluation changing in the short term. But what I can do is I don't have to play and buy those overvalued areas. I can sit in undervalued sectors with great bottoming chart patterns like stage analysis, stage 1 and stage 2, just breaking out. It's going to take time, but my risk reward is far better than anything the market has to offer today anywhere else. And then I can just sit there, buy these cheap investments, and ride it on up. Paladin Energy recent update indicates that uranium production at the Langer-Heinrich mine has been lower than expected, with challenges in ramping up production affecting output. As a result, Paladin has revised its full year 2025 production guidance down to 3 to 3.6 million pounds of uranium from the previously anticipated 4 to 4.5 million pounds. This reduction in anticipated uranium supply could contribute to tightening the supply-demand balance in the uranium spot market, potentially leading to an increase in spot prices. Additionally, Paladin noted that production variability and operational challenges are influencing unit operating costs and realized prices for uranium sales, suggesting that the costs associated with uranium production might rise. If other uranium producers face similar issues, it may reinforce upward pressure on uranium spot prices. Overall, Paladin's report ongoing production challenges in the uranium sector, which could lead to increased spot market prices if supply constraints continue. Spot uranium higher, much higher, and it will take long-term contracts with it. Ferocious. And Paladin was down quite a bit today. Now, the way that I read this is that Paladin is struggling to increase production, and on top of it, their costs are increasing. I can't imagine the majority of these other developers going through this and having it be easier than Paladin. So I have a feeling that all of the companies that are developers are probably going to have cost overruns. They're probably going to have delays. They're probably not going to hit targets. And it's going to be a lot more expensive to produce from their projections than what they have planned if Paladin is running into all of these problems. That is my guess. Here's another one from Bruce Lee. One of the best lessons you can learn in life is to master how to remain calm. Calm is a superpower. You know what else is a superpower? And this is kind of, I don't know if it's an art, but the art of not giving a crap. If you don't care, you can remain calm. I did that at my old job where I cared to keep my job and I cared that I did a good job. But I was put in a lot of situations that I had no control over the outcome necessarily. So there were a lot of things that came in, we'll call it parts short. And I remained calm by saying, that isn't my problem. If the parts aren't here and I can't, direct the entire facility to get this out in a particular time, I can't do anything about it. We'll try our best. And that was one of the ways that I remained calm. Is I said, is it within my control? Not really. JH, I know there are points to be made about correlation between inventory and prices, but it's undeniable that total inventories are at an absolutely low level today in terms of oil. And this is observed oil inventories. And what we're looking at here is the net change in observed total inventory. So this was a surplus above zero. Then we went into negative, which is a deficit. We've been eating through inventory levels from middle of 2021. And the inventory levels have been basically shrinking. And right now, it's continuing to shrink. HFI research says, oh man, what data are these guys looking at? This is from the IEA. Quarter 3, 2024, 103.6 million barrels per day. Quarter 3, 2024 is 102.9 million barrels per day. We are increasing demand by that difference. By that difference. Coming down, JC Parrott says, these are the four most important charts in the world if you believe that the next leg of the bull market just got started. Or if you think it's time to sell stocks, there are also four more most important charts. So Amazon starting to break to the upside. We've got The small cap 600 SML breaking to making all-time highs. We have the Dow Jones Transportation Average breaking to the all-time, and then we've got Bitcoin also breaking to all-time highs. And he thinks that these four are the most important charts to be looking at right now. Crude oil is trying to dig in here relative to gold. What that means is that crude oil priced in gold, when this goes down, gold goes up and beats crude oil. When this digs in and tries to go up, that means that crude oil outperforms gold. So what he's saying is potentially crude oil is trying to outperform gold here. We can see the relative strength indicator. It went up originally in the beginning of 2020, and now we're starting to go up originally here. We've also broken the downtrend here too, or about to break this downtrend coming through here. So crude oil could be trying to make its way higher here. We'll have to wait and see. We haven't broken out yet. Grady says, and don't forget about platinum. Hold on here. Just like silver was, platinum is sitting right below a historical huge blue breakout line. It has been in a cyclical bear market for 15 years and is about to break out and resume its secular bull market. A generational breakout and opportunity is incoming for also platinum. It has now been basing out for about 10 years, just like back before the start of the secular bull market back in 1990s. The coming blue breakout will confirm the resumption of the secular bull market for also platinum. And the coming blue breakout will also confirm that wave 3 has started, which is the strongest and most profitable phase. Platinum has a very, very long way to go. What the exact final target price will be is not important right now, really. What is important is to get ready and to get real guidance along the way. We've been getting prepared at the service. And exactly, I've been buying this platinum and some of these other metals at very low prices, and we're about to break out. And from a ratio perspective, again, platinum is still an amazing investment. How cheap it is against all the other metals. Every time in history, if you had purchased the metal when it was incredibly cheap against the other metals, you made gangbusters of money. Gold was like that in 99, 2000. Silver was like that in the early 2000s. Palladium was like that in 2005 and 2009. 2016, rhodium was the cheapest against all of them, and now platinum is today. Platinum is cheaper on a ratio perspective than silver is. It is way cheaper than silver. Think about that for a second. I hear people say silver is the cheapest, the cheapest metal or cheapest investment in the world. It's like, no, it's not. Platinum is on a ratio perspective given history. Coming down, we've got Bradley Foster. So these are U.S. daily electricity generation mix for ERCOT down in, I think, Texas is what that is. Natural gas is 57% of electricity generation on ERCOT. Coal is 16%. Wind is only 7%. Or solar's 13%. Wind is 7%. And this is so that's 2024. In 2023, natural gas was only 51%. Wind was 19%. Solar was 3%. And coal is 17%. So the majority of that has shifted into nat gas. And I think that shift will continue. More and more nat gas. Edward says, either the spot market has really dried up, volume is even lower, and no one is willing to buy on the spot market so that price doesn't rise. Thus, manipulating the spots downwards causes the shares to also fall. And he's talking about uranium. Or there are very large stocks of uranium out there. Something is wrong because it's just news after positive news of increasing demand for uranium through new nuclear power plant projects, restarts, extensions, SMR, AI, etc. And the shares don't respond. You are describing news and you're leaving out sentiment. Sentiment shifts from positive to negative, and that's what shifts these funds flows in and out of uranium stocks. And that's how the markets work. These companies are 100% reliant on retail, for the most part, retail investors' sentiment. And retail investor sentiment shifts dramatically in favor and out of favor. with a lot of these companies that are these small caps. These are not cash flow rich companies that are buying back shares. It's not like oil and other sectors. So these are going to have larger pullbacks. They're going to be more pronounced and they're going to suck a lot more. That's just the part of the game. You got to learn the game if you want to win this thing. And being in this game here, you just have to ride. And you're going to get vicious pullbacks. That's the way it is. The way it is. And that's where portfolio allocation is so important. If you have exposure to these sectors, you need to figure out a portfolio allocation that suits your personality and your conviction in the sector. Kurt says, we're likely in the final phase of the bull market cycle, the blow-off phase, with sub-phases of renewed optimism, FOMO, and now possibly euphoria. Last week's 5% gain in the S&P 500, despite late cycle signals like a yield curve inversion and rising unemployment, suggests we're near the peak. The presidential election may support business sentiment, but it doesn't shift the economic trend overnight. This looks more like a late cycle rally with growing risks than the start of a new bull market, which I agree with 100%. And this back here was probably in 2010 and 11. Smart money buys, you come all the way back up, and these are all the years going through it. He is correct. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.